With the S&P 500 at all-time highs, it's becoming harder to find real value. That said, today I'm going to share 3 sectors that I've been buying and believe are currently undervalued, along with specific companies as examples. And the first sector is payment processors, which have been heavily sold off. For example, a company I've been buying is PayPal. And if we take a look at the chart, it is down 75% in the past 5 years, and it had an all-time high of $308 per share. It is currently trading at a forward PE of 10, although we'll talk later about the valuation with a discounted cash flow model. One of the reasons PayPal stock is down so much is because people say it's a dead company. However, if we take a look at revenue, it has grown from $9 billion to $32 in the past decade, and analysts are still expecting solid growth as they have PayPal reaching $33 billion this year and grow to $43 by 2029, so around 6 to 7% compounded annual revenue growth. Profit has also seen great growth as net income has grown from $1.2 billion to $4.9, and one thing that I like is that they have even more free cash flow, currently at $5.5 billion. And they have great margins as well, with gross margin at 41%, profit margin around 14%, and free cash flow margin around 16%. Analysts are also expecting profit growth. They have PayPal making $5.47 per share this year and grow to $9.23 per share in 2029. If you assign a 15p to the company then, it would make it a $138 stock, meaning 131% returns from current levels, so great returns according to analysts. PayPal also has a great balance sheet as they have $10 billion in cash and 12 in debt, so they have a lot of cash, and they are using this cash to return value to shareholders. They now pay a small dividend which has a yield of 0.96%, which means you get 56 cents per share annually. I actually don't like this because I believe dividends should be the last resort to use the remaining cash. I would prefer if PayPal used this cash to reinvest in the business or buy back more shares, which they have been doing. This is another catalyst because this means that as an investor, there are less shares outstanding, which means you are sharing the profits with less people and you own more of the company. It is important that share buybacks are done when the company is cheap and not expensive, and I believe PayPal is very cheap, currently trading at a forward PE of 10. Share buybacks are extremely important, and if you want to learn more, I would recommend you reading 100 Baggers, which is a study on multi-baggers by Christopher Mayer and has a whole chapter on the importance of share buybacks and how it can accelerate returns. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $68 per share, middle 93, and high 124. And because the stock is currently trading at $58 per share, this means that if my low assumptions occur, you would get a 13% annual return on your money, middle 19.2%, and high 25.3%, which are amazing returns, and this is the reason why I am buying PayPal. And I also believe my assumptions are conservative. They have PayPal growing revenue between 4 and 7% annually for the next 7 years, averaging a profit margin and free cash flow margin between 13 and 17%. I assigned a PE and price to free cash flow at the end of the 7 years of 15, 17, and 19, and I didn't even assume any share buybacks, just to be more conservative. But if we go back to our 10% annual return to calculate intrinsic value, because this is what the market returns on average, and we assume PayPal buys back, let's say 2% of their shares annually, for the next 7 years, the valuation becomes even more attractive. And keep in mind they also own Venmo, which grew 20% last earnings, and they are also growing total accounts and total payment volume. The only negative aspects are that payment transactions are decreasing, and that there are tons of companies in the fintech space. However, I believe PayPal is well positioned because it has a security mode, meaning people trust it. I've been buying PayPal under $58 per share for a while now, and I believe this stock will beat the market in the upcoming years. The other company in this sector that I'm buying is Fiserv, which is down 68% in the past year and now trades at a forward PE of 8. Fiserv has 2 main lines of their business. First is their merchant side of their business, which is Clover. A lot of medium-sized businesses use it. This is very similar to Square or Shift4. And then the other line of business is financial solutions, which is their banking, payment processing side of the business. And you can see it by segment right here. Fiserv has a ton of banking clients, and they offer processing systems that handle the deposits, the loan, customer accounts. They are like the operating system of a bank, which is why I believe this revenue is very sticky. It's like recurring revenue. And as you can see, the revenue has seen very good revenue growth in the past 5 years, growing from $14 billion to 21 currently, which is a compounded annual growth rate of 8.4%. However, in the last earnings, they guided for 3.5 to 4% revenue growth this year, which is why the stock is down so much. Now, regarding profit, their net income has also seen good revenue growth in the past 5 years, growing from $958 million to $3.6 billion today. And they have even more free cash flow, currently sitting at $4.6 billion. And profit is going to continue to grow very fast because they have amazing margins, with gross margin at 60%, profit margin at 17%, and free cash flow margin at 21%. So they have even better margins than PayPal. And like PayPal, they are buying back a ton of shares now that the stock is cheap. And the company looks heavily discounted on the spreadsheet as well. As you can see, intrinsic value of 79 according to the low assumptions, 115 according to the middle, and 162 according to the high. And because the stock is currently traded at $66 per share, if my low assumptions occur, you would get a 13.3% annual return on your money, middle 21%, and high 28.2%. By the way, if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And in my opinion, Fiserv has more potential than PayPal, but it also has more risk. The reason is because of the amount of debt. They have $1 billion in cash and $30 billion in debt, which is substantial for a company that has a market cap of $38 billion. And there are other companies in this sector as well, such as Shift4 Payments, again trading at a 4P of 10, or Block, but in my opinion, PayPal and Fiserv are the most attractive in this sector. Next sector that has been heavily sold off this year, and I believe it discounted, is the sport apparel sector. An example is Lululemon, which is down 44% in the past year, and I actually bought the stock when it was trading at around $167 per share. Now we are up over 20% in that investment. Main reason why this sector has been sold off is because of tariffs. The company estimates that the combined impact of these tariff changes will reduce their gross margin by about 230 basis points, or 2.3%. However, if we zoom out over the past decade, Lululemon's revenue has grown consistently, from around $2 billion to over $11 billion today. And looking ahead, analysts still expect growth, though at a slower pace. Revenue is projected to reach $15 billion by 2031. Profitability has followed a similar trend. Net income has risen from $266 million to about $1.7 billion currently. However, there's a recent negative point. Free cash flow has dropped from $1.6 billion to $1.1 billion over the past year. Not disastrous, but worth watching. And analysts forecast that earnings per share, or EPS, will dip slightly in the next 2 years before rebounding strongly. They expect Lululemon to earn $12.86 per share in 2027, and then grow to $26.16 by 2031. If you assign a 15p to those earnings, it would make it a $392 stock, meaning 85% upside from current levels. And on the discounted cash flow model, as you can see, it looks like it's still trading at a discount, as they have intrinsic value of 139 according to my low assumptions, 221 according to the middle, and 330 according to my high. And the stock is currently at 211, therefore if my low assumptions occur, you would get a 2.6% annual return on your money, middle 10.8%, and high 18.5%. More positives about Lulu is again share buybacks when the company is trading cheap. The balance sheet, as they have basically no debt, and they have a 25% return on invested capital, which is an amazing statistic to have. But because my average is $165 per share, I am not buying more Lulu unless it falls again under that price. I am not ready to sell either because I still think the company has a lot of potential. Another very interesting company in this sector is Crocs, which is down 20% in the past year and now trades at a forward P of 7. Their shoes are very famous and people either love them because they are really comfortable or hate them because they believe they are ugly. But biases aside, their revenue took a big jump from 2020 to 2023. However, since then, it has remained at around $4 billion, and analysts expect them to stay at $4 billion for the next 3 years. If we focus on free cash flow, again, it grew massively in those years and it is now at $700 million. Crocs actually has fantastic margins, as gross margin is around 60% and free cash flow margin at 17%. And as you can see, this is a company that has been buying back, again, a ton of shares, which, like I've said before, can accelerate returns massively. Their last earnings weren't great, as they reported 3% negative revenue growth on their Crocs segment, and what's even worse, the Hey Jude brand saw 22% year-over-year declines. This was a horrible acquisition the company made a couple of years ago. But you have to keep in mind, as a value investor, that even declining businesses have value. And actually, if you look at my assumptions, I have negative 2% revenue growth on the low assumptions, 0% on the middle, and 2% on the high, averaging a profit margin and free cash flow margin between 14 and 20%. I assigned a very low multiple of 8, 10, and 12. And I also assume they buy back 2% of their shares annually. And as you can see, stocks looks very cheap, as I have intrinsic value of 92 on my low assumptions, 139 on the middle, and 202 on the high, which means that if my low assumptions occur, you would get an 11.3% annual return on your money, middle 20.3%, and high 29%. As you can see, this stock has a lot of potential for huge returns. It is on my watch list at the moment, and the only issue I have is if this is just a short-term trend or something that's going to stay popular long-term, which is the issue in the fashion industry. If you're serious about investing, you know that picking the right stocks isn't just about the story, it's about mixing it with the numbers. And that's exactly where stockanalysis.com comes in. This site lets you dig deep, chalk up to 10 years of historical financial performance, see revenue, profit, margin, dividends, everything. If you want a discount code, you have mine in the description. They also have a free newsletter that highlights important market moves and stock fundamentals. Perfect if you want to stay informed without spending hours digging through data. I hope you found this video valuable. Let me know what you think about these sectors in the comments, and I'll see you in the next one.